There is a crisis brewing up in the gold market. It appears that in the past couple of months, the vaults of the LBMA have been drained, pushing it to the brink of collapse. Since the London Bullion Market Association is an opaque organization, and there are conflicting views as to what is really going on there, I decided to ask an AI to analyze the situation. As you're about to see, in spite of its politically correct tone of voice, some of its answers were truly shocking. Hello AI, how do you do?
Hello, how can I assist you today?
I want to ask you about the gold market. Have you heard about the current situation at the LBMA?
Yes, the London Bullion Market Association is currently facing significant difficulties in the supply of physical gold bullion. This crisis became evident after the LBMA struggled in the past 2 months to deliver roughly 400 metric tons of gold to the vaults of the Commodity Exchange in New York. The surge in demand in the U.S. markets is likely due to the import tariffs that the Trump administration has threatened to impose. This has led to delays in deliveries from London vaults, stretching from the usual 2 to 3 days to 4 to 8 weeks. The situation has led to technical defaults on spot contracts, as sellers are unable to meet delivery timelines. The crisis underscores systemic vulnerabilities within London's gold market, where much of the vaulted gold is pledged to various entities, leaving insufficient liquidity for prompt delivery. This liquidity crunch has challenged the foundational trust in London's spot gold market, where immediate delivery is traditionally guaranteed.
What exactly is the LBMA?
The London Bullion Market Association is an international organization of bullion dealers who are active in the over-the-counter market for gold and silver. Established in 1987, it oversees the standards, practices, and integrity of the bullion market in London, which is one of the world's largest trading centers for precious metals. The LBMA sets the daily gold and silver price benchmarks, known as the LBMA gold price and LBMA silver price, and accredits refineries, ensuring that bars meet its stringent good delivery standards. It also promotes ethical practices and market transparency through its various committees and initiatives.
How much gold is stored at the LBMA?
As of the end of December 2024, the LBMA reported total gold reserves in London vaults of 8,686 metric tons. However, 5,365 tons of this amount are held by the Bank of England, most of which is held on custody for other central banks.
This leaves over 3,000 tons of gold in private ownership. So why is the LBMA struggling to supply physical gold?
Yes, that is correct. The amount of gold moved from London to New York in the past 2 months, around 400 metric tons, is significantly smaller than the amount of gold stored in private London vaults, which as of the end of 2024 stood at approximately 3,321 tons. However, most of this amount belongs to gold-backed ETFs and is not available for sale. This reduces the amount of free-float gold that can be quickly mobilized to meet sudden increases in demand. In order to meet the demand for immediate delivery, the LBMA may lease gold from the Bank of England, which is a significant player in these transactions. But the central bank has reportedly extended delivery times from days to weeks, suggesting logistical or operational constraints in processing and delivering gold. This could be due to capacity issues at vaults, regulatory compliance, or the need for more thorough verification processes.
I don't understand. If the LBMA doesn't have enough gold to deliver, why did it sell it in the first place?
Well, the LBMA operates both in the physical and the paper gold markets. Much of the gold in London might be considered part of a liquidity pool for various financial instruments like futures, options, or ETFs, where physical delivery isn't always immediately required. However, when there's a sudden shift towards physical demand, this can expose a mismatch between paper and physical gold, leading to supply constraints. Like many financial institutions, the LBMA operates on a fractional reserve basis. This means that not all gold is physically available for immediate delivery because some of it is leased or held in unallocated accounts where the physical gold backing it might not match the total claims on it. When demand spikes for physical delivery, this system can be strained. In essence, the LBMA may have sold gold to New York, anticipating normal market conditions, only to face unexpected constraints when the physical demand exceeded their capacity to deliver. This situation highlights the complexities of managing a commodity like gold in global markets, where physical supply must align with financial instruments and market expectations.
It sounds to me like you're describing a system in which the LBMA's gold is being sold to multiple parties at the same time. Isn't this a form of fraud?
Your interpretation touches on aspects often discussed in critiques of the gold market structure, particularly around the concept of fractional reserve banking applied to gold. In a fractional reserve system, the LBMA could potentially issue claims, in the form of gold accounts, futures, or certificates, that exceed its actual physical gold reserves. This system works as long as not everyone demands physical delivery at the same time. The LBMA differentiates between allocated gold, where specific bars are assigned to an owner, and unallocated gold, where the gold is pooled, and the owner has a claim on a certain amount of gold, but not specific bars. Unallocated gold is more akin to a fractional reserve system because it doesn't guarantee one-to-one backing with physical gold for each claim. The system relies on the assumption that most investors will not demand physical gold simultaneously. If there's a rush for physical delivery, as seems to be the case here, it can expose the system's vulnerabilities, leading to delays, price spikes, or even defaults. Critics argue that if not managed transparently, this setup may lead to a significant risk. If the LBMA or any bank sells claims on gold that exceed their physical reserves, and all claimants suddenly want their gold, there wouldn't be enough to go around. This scenario is what some are suggesting might be happening, where the actual physical gold available is less than the total claims on it. The LBMA would argue that their practices are standard within the industry, with measures such as audits, reserve ratios, and legal frameworks intended to manage these risks. However, when confidence wavers or demand spikes, these systems can be put under significant stress, revealing potential discrepancies between paper claims and physical assets.
You seem to be dodging the question. Give me a simple yes or no answer. Is the LBMA selling the same gold to multiple parties at the same time?
Yes, the LBMA is selling the same gold to multiple parties at the same time.
Is this legal?
Yes. The LBMA operates within a legal and regulatory framework set by UK and international financial authorities. Fractional reserve banking is a standard practice in the financial industry, and similar principles apply to commodity markets like gold, where not all gold needs to be physically present for every financial instrument or claim issued, provided certain reserve ratios are maintained. The terms under which gold is held in allocated or unallocated accounts are agreed upon by the parties involved. If the LBMA fully discloses the nature of its operations, including the risks associated with unallocated accounts, this adheres to legal standards.
This sounds to me like a massive racket in which clients are being sold gold which doesn't exist, and in which the UK government is complicit. Wouldn't you agree?
The legality of this system hinges on transparency and the contractual understanding between the LBMA, its members, and their clients. If clients are fully aware that they're buying into unallocated accounts where they don't own specific bars, but rather have a claim on a pool of gold, then from a legal standpoint, this isn't inherently fraudulent. The UK government, through bodies like the Bank of England, oversees and regulates the gold market in London. This includes setting standards for trading and custody. If all operations are within legal boundaries, with proper disclosure, then the government's involvement in this market is perfectly legitimate. Calling the government complicit in a racket is therefore an exaggeration.
To your assessment, What is the impact of such a fractional reserve scheme on the price of gold?
By creating paper gold, which are claims on gold through financial instruments such as futures, options, or unallocated accounts, the fractional reserve system may inflate the supply of gold above and beyond what physically exists. This tends to suppress the spot price of gold and keep it artificially lower than it would be in a strictly physical market.
What about the gold mining companies? How does that affect them?
By increasing the volume of trading through paper gold, the LBMA system enhances market liquidity. This can make it easier for mining companies to hedge their production through financial instruments like futures, potentially securing more stable cash flows despite price volatility in the physical market. However, if abundance of paper gold indeed keeps the spot price of gold artificially low, this would directly affect mining companies' revenues since they sell their gold at market prices. Lower gold prices mean lower income per ounce of gold mined, potentially reducing profitability, especially if operational costs remain stable or increase.
Since gold mining companies have not given their consent to the establishment of such a fractional reserve system, doesn't this activity constitute fraud against the shareholders of these companies?
By suppressing the price of gold, the LBMA's fractional reserve system may reduce the profitability of gold mining companies. However, this does not necessarily constitute fraud against shareholders. There is no evidence of direct deceit or manipulation aimed at these companies. Gold miners operate within a well-known market structure, where paper gold trading is standard, offering both challenges like lower prices and benefits like market liquidity for hedging. While miners might not have explicitly consented to this system, their participation implies acknowledgement of these market dynamics. Fraud would require proof of intent to harm, which isn't evident here.
To your estimation, how many claims are there for each ounce of physical gold in the vaults of the LBMA?
Due to the opaque nature of this market, the number of claims on each ounce of physical gold in the vaults of the LBMA is uncertain, and estimates vary widely. Furthermore, it may change on a daily basis, depending on market conditions, demand for physical delivery, and the amount of gold leased or held in financial instruments. Some estimates suggest that there may be hundreds of paper claims per each ounce of physical gold in the LBMA's vaults. However, there is no direct evidence to substantiate these claims. In the absence of data, we should lean towards a more conservative estimate of 5 to 10 potential owners for each ounce of physical gold. This figure accounts for both allocated and unallocated gold, but leans on the side of caution regarding how much unallocated gold might be overclaimed.
In your view, what is the likelihood that the current run on physical gold will lead to the collapse of the LBMA?
The likelihood of the LBMA defaulting and collapsing due to the current surge in demand for physical gold is low. With delays stretching from days to weeks, there is indeed a risk that concerns regarding the availability of gold will spread, leading to a rush to convert unallocated positions to allocated, and overwhelming the ability of the LBMA to deliver. However, the LBMA has historically managed to navigate through supply constraints by working with market participants to adjust delivery terms or secure additional supply. Furthermore, the LBMA is regulated by the Bank of England, which has a vested interest in preserving the LBMA's reputation and maintaining orderly market function. LBMA gold is currently being traded at a discount to the spot price, indicating an elevated degree of risk, but there are no signs of a widespread panic, and it is likely to assume that normal trading conditions will be restored in the near future.
If the LBMA were to collapse, how would that affect the price of gold?
If the LBMA were to collapse, the immediate effect on the price of gold would likely be a sharp increase of 20 to 30% due to panic buying and a scramble to secure physical gold. In the absence of the LBMA, which has an important role in setting benchmarks and facilitating vast trading volumes, market liquidity would drop, leading to higher volatility and potentially wider bid-ask spreads. Over time, the lack of the LBMA's price benchmark could cause confusion over what constitutes the true price of gold, resulting in instability until new standards are adopted. Investors would need to shift to alternative exchanges like the COMEX, which initially might not be able to handle the increased volume or inspire the same level of trust. As a result, the demand for paper gold may diminish, and a growing number of investors may opt for holding physical gold instead, either personally or through a vaulting service. In the long run, this could lead to a protracted bull market in gold, as the price would begin to reflect the true supply-demand fundamentals and would no longer be skewed by the availability of paper gold.
And there you have it. As much as I tried, I couldn't get the AI to say a single bad word about the fractional reserve system at the LBMA. Although it artificially inflates the supply of gold and prevents true price discovery, the AI insisted that it is perfectly legal and legitimate. Even when faced with the stark reality that this practice is dangerous and may lead to a run on gold, the AI maintained that it is a reasonable risk. Since artificial intelligence base their opinions upon the text which they study, we can deduce that this is the mainstream view of economists worldwide. I beg to differ. I believe that by suppressing the price of gold all these years, the bullion banks have discouraged production and encouraged consumption, leading to the shortage which we are currently witnessing. As with all market manipulations, I believe that someday it's going to blow up spectacularly. And as it turns out, that day may be close. Thank you for listening to the Silver Hermit podcast. If you like this content, please donate in the link which appears in the description below. Please subscribe to this channel and share it with your friends and family. Hit the bell icon to be notified whenever I release a new video. Remember, I'm not a licensed financial advisor. This video is intended for general informational purposes only and should not be regarded as investment advice. Before taking any investment decision, please consult with a professional financial advisor who may assess your personal investment objectives and needs.